Hi, my name's Griffin Bridgers. Today we're going to look at a hidden requirement for the estate tax marital and charitable deductions and how seemingly innocuous requirements on their surface can create some downstream issues depending on how property might get included in a gross estate for estate tax purposes. Before I get started, I want to remind you this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. Now, on the gift and estate tax side, just to set the stage, you can offset gifts and estate taxes by a deduction for qualifying transfers to a spouse or charity. In the case of gifts, it's a deduction against your lifetime or your annual gifts. In the case of the estate tax, it's a deduction against your adjusted gross estate. We won't get into the splitting of hairs on those types of qualifying transfers and how you get the deduction itself. It's more a fringe issue that we're going to check out, but it's still a fringe issue that has to be drafted around. So no guidance is in this presentation on qualifying transfers or even qualifying charities. Because before you can get to those issues, there's some baseline requirements that you have to make sure that you don't take for granted. So let's see where these requirements might kick in. Let's imagine we have either of these scenarios, maybe property not owned by a decedent that's maybe subject to a power of appointment at death under Code Section 2041, which, to clarify, that code section includes property in the gross estate if it's either subject to a general power of appointment or is subject to an actually exercised limited power of appointment that's exercised in a manner that resets the applicable rule against perpetuities that the property was subject to. In other words, the Delaware tax trap. That latter example, I wouldn't worry about too much. More often, you're going to see this first point when you have general powers of appointment. Another scenario might be that the decedent has previously transferred property, but it's now included in the decedent's gross estate under Code Sections 2036 through 2038, or maybe 2042, through some sort of retained power, control, or right. And both of those scenarios lead to inclusion of assets in the gross estate. However, in both of those scenarios, the question is what can be done at death by the decedent to maybe offset the increase in estate tax. And in that case, there's a potential mismatch you have to look to. You have to look to what property is actually subject to disposition by the decedent versus what property is actually included in the gross estate. Because you might find out that the decedent doesn't have the power to actually control the disposition of the actual property included in the gross estate. So this can create this unforeseen matching problem that's going to pop up, mainly because the property is held in an entity or a trust, and the decedent's power is usually at the entity or trust level and does not look through to the property included in the gross estate itself. So we're going to first look at the estate tax marital deduction. This is created under Code Section 2056, which imposes three high-level requirements for an estate tax marital deduction. One, you have to have an interest in property. Two, that interest in property has to pass from the decedent to a surviving spouse in a qualifying transfer, which we're not going to get into today. But more importantly, three, you only get the marital deduction to the extent that the value of the property interest that passes from the decedent to the surviving spouse is actually included in the gross estate. This is an express requirement in the tax code. So in other words, the property interest passing to the spouse has to be included in the gross estate. This seems intuitive, but it's not. In this vein, we have to consider whether there's a mismatch between maybe entity interest or trust interests and interests in the underlying assets that are indeed included in the gross estate. Now, in this scenario, if we have a power of appointment involved, the mismatch usually won't be an issue, even though technically the power of appointment applies to a trust interest, whereas the gross estate is for the underlying assets of the trust. The gross estate inclusion is for the underlying assets of the trust. But we have an exception here, Code Section 2056C6, which kicks in to make the power of appointment as a property interest eligible for the marital deduction if that power is actually exercised to a spouse, or if the spouse takes as a result of the non-exercised power of appointment, which could be in the form of a cascading power of appointment. Now that's a special planning point in and of itself that we should discuss another time, but the result is that this mismatch is harder to encounter in a trust. Why? Because a power of appointment itself does indeed apply to the underlying assets that are included in the gross estate. So even though you have a trust interest, it's not necessarily the trust interest that is subject to the power of appointment, it's the underlying assets of the trust itself. So powers of appointment are a good way to get around this issue, but the contrary issue is where entities are involved, because typically we don't see a power of appointment in an entity. So this is where the mismatch tends to kick in. Now I have a highly imperfect example here, which I'm just going to bat around to illustrate one piece of technical guidance before we move on to the charitable deduction. But let's take, for example, we have an entity that's held 20% by the decedent, which holds life insurance on the decedent, and the life insurance gets 100% included in the decedent's gross estate under Code Section 2042. So all the decedent might control is a 20% entity interest. There's no power of appointment that could dispose of that life insurance at the entity level itself, which begs the question of whether the decedent could offset the 100% life insurance inclusion in the gross estate by a transfer of the 20% interest maybe to a spouse. And the answer is no, because it's not deemed to be a 100% entity interest included in the gross estate. Instead, it's the life insurance itself that's held by the entity, which the decedent has no control over to dispose of at death. So if the decedent was somehow able to look through the entity and send the life insurance to the spouse, we could somehow get this marital deduction. But a lot of entities won't have that level of control. So for an example of this, I direct you to Technical Advice Memorandum 2004-32015. And if you want a good write-up on that, see my blog or my newsletter at griffinbridgers.substack.com. I have a good write-up on that from a few months ago where it talks about saving a busted entity through a marital deduction not so fast. So look for that article, and that'll give you a little bit better guidance on that issue. But we turn our attention to the charitable deduction as well, because we see this exact same issue rear its ugly head in this scenario. And this code section 2055 that grants the charitable deduction, before we get into the qualification of charities or transfers, it has similar requirements to the marital deduction, but worded a little bit more specifically. For one, you have to have either a bequest, legacy, device, or transfer to a qualified charity, and that bequest, legacy, devise, or transfer has to come from property included in the gross estate. Now, as I mentioned with the marital deduction, we have the same exception for powers of appointment under Code Section 2055B. Once again, you can look through the power of appointment and look at the fact that the power of appointment actually relates to the disposition of the property that's both included in the gross estate and subject to that power. But in this case, we don't have the requirement for the exercise of the power, which, like I mentioned with the marital deduction, power of appointment planning is worth digging into. So a couple points I want to mention here is that property included under the gross estate under Code Section 2041 that is received by a qualified charity is treated as a bequest by the decedent in this vein, meeting that bequest requirement above. So we have a very permissive analysis for powers of appointment, but not so for Code Sections 2036 through 2038. Now, if you retain a power of appointment, that could be a Code Section 2036 type of transfer, because 2036 overrides 2041 in that vein. But like I said, that's also a good topic for another time. But the big picture here is that, like before, we may not have to worry about this estate tax charitable deduction mismatch as much when we have a trust with a power of appointment involved, but it's still worth checking. Again, where this becomes more of an issue is when you have entities involved, because we have to consider the type of entity in question and the transfers to it, but we have an added wrinkle here. What if the entity in question is itself a charitable entity? You may not have as punitive of an outcome, but the outcomes could still be unexpected. Now, as a threshold case, we're going to start off with a non-charitable entity, as we saw with the marital deduction. Maybe we have inclusion of underlying assets of a non-charitable entity in the gross estate under Code Sections 2036, 2038, or that's a typo, that should say 2042 for life insurance. And maybe that gross estate inclusion is coupled with the contribution of the entity interest itself to a qualified charity, because that's all the decedent can control is the entity interest and not the underlying assets. And in that case, that type of transfer may not qualify for an estate tax marital deduction to offset the increase in estate taxes through that gross estate inclusion under 2036, 2038, or 2042. For example, I direct you not to the tax court case itself, but to the Ninth Circuit appeal of Estate of Howard Moore versus Commissioner from the Ninth Circuit in 2021. There's also some other fringe scenarios to consider in this vein. One is that transfers to a charitable foundation itself could be included in the gross estate. And this is something that a lot of people who set up family foundations tend to not think about as much, or they take for granted because it's assumed that maybe the estate tax charitable deduction would offset that. And I'll mention why that may be a dangerous assumption in a second. But as a threshold case, and this is a vein, again, worth digging into a little bit more, let's take maybe a decedent who creates a family foundation and at the time of death is a director or officer of the foundation who has the power in that role, alone or in conjunction with others, to direct funds for charitable purposes. In that scenario, the property might be included in the gross estate, but it may still qualify for the charitable deduction, especially to the extent the property itself had been transferred by the decedent to the foundation during life. So for an example of that, I'd direct you to Revenue Ruling 72-552. Now, there could also be a split of an entity interest between qualified charities and non-charities, or maybe just between qualified charities itself. So the question there isn't necessarily whether you get the charitable deduction, because we may not have the mismatch situation in that case, but the question may be more whether you get a full estate tax charitable deduction. And the answer is possibly no, because if you have an entity interest and you divide it, that could create a discounted value to the charity. So at your death, you own a larger entity interest, or maybe 100%, which isn't subject to discounting, or maybe an interest that is subject to a control premium, but that control premium may not carry over to the ultimate recipients of that entity interest when it's divided up. So for example, I direct you to two cases here. One, a recent case from the tax court, Estate of Warne versus Commissioner, where a 100% charitable interest was divided 75-25 between two charities. And in this case, even though the full 100% value undiscounted of the entity interest was included in the gross estate, the estate tax charitable deduction was reduced by the discount to the discounted value of the entity interest going to the two charities. So that discount leaves a donut hole of added estate taxation that a lot of people don't consider, for example, when they're drafting estate tax charitable deduction formula clauses. This could also happen when you have a division of an entity interest between a charity and non-charity. You, again, may not get a charitable deduction for the full value of what's included in the gross estate of the entity interest that is thus further divided between the charity and non-charity, as we saw in Amundsen Foundation versus the United States out of the Ninth Circuit in 1981. So what are our key takeaways here? Well, for one, when trusts are involved, especially lifetime gifting trusts that could later be included in the gross estate, care must be taken to draft around the issue of whether Code Sections 2036 through 2038 or maybe 2042 may apply. So for example, on the 2042 issue, you may sometimes see this in single life ILETs where it has a savings clause where a contingent marital trust could be established if the life insurance itself ends up included in the gross estate of the insured. But where entities are involved, it's not quite as simple as you see with gifting trusts and getting around that issue, especially when you layer things together. If you have entities gifted in trust themselves, even if you can get through the trust level issue with maybe a power of appointment, you still have to consider whether the gross estate inclusion or even the discounting issue could apply at the trust level. You may have to address it at the entity level. So for example, could a marital or charitable recipient of an entity interest have a look-through right to demand liquidation of the entity like we saw with the general power of appointment, where really you have a right you're granting or creating that applies to the property that's included in the gross estate itself? And if you do that, what other issues might that create? That could, open up a whole nother Pandora's box of things we haven't even considered yet that have downstream transfer tax repercussions. And again, what we haven't addressed, which is a subject for another time, is the non-estate tax issue, the basis step-up issue with this mismatch. But with that last point, I'll leave us with lots of fodder for future videos. As always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com with the caveat that I cannot give tax or legal advice in response to your questions. But I thank you again for listening to this video, and I look forward to seeing you in my future content.